The 2008 Financial Crisis in 3 Minutes by me. In the year 2006, where the economy was finally back to pre-dot-com bubble conditions, investors were looking for a new investment opportunity other than your typical stocks and bonds. With interest rates being so low, everyone was buying a house, so investors knew that there was profit to be made in the housing market. But how? The answer was mortgages. But investors didn't want to invest in Noor Mahan, Bill's, and Sarah's individual mortgages. They knew that would take up too much time, and that's where investment banks came in. Investment banks, with their billion-dollar budgets and industry knowledge, decided to pool heaps of mortgages together, way more than just Nora Mahan's, Michael's, and Shannon's, and sell shares of the pool to investors as mortgage-backed securities. This meant that investors were the ones giving out mortgages, and with mortgage demand being so high, sure enough, people flocked to the investment banks to buy up their securities. But it wasn't just the banks. The government, in efforts to boost mortgage lending, used its sponsored companies Fannie Mae and Freddie Mac to do the same exact thing. Mortgage lending and home buying skyrocketed, reaching record highs, and investors were getting very rich in the process. Insurance companies noticed this investor success and wanted to get in on the action. Their answer was credit default swaps, which were sold by insurance companies to mortgage lenders, saying that they would pay them if their homeowner was to default on their mortgage, or in other words, was not able to pay their mortgage payments anymore. This was a win win for both insurance companies and mortgage lenders because insurance companies were getting a share of the mortgage lender's profit while mortgage lenders were reducing their risk. While this seemed like a perfect system where everyone goes home rich and happy, there was one major issue, and that was the now lack of risk management from the money hungry lenders who were giving out loans to people with bad credit scores and low incomes. These subprime mortgage loans that promised to homeowners that they were making a good investment were actually riddled with terrible conditions in the fine print. Soon, these unqualified tenants started to default on their payments, and the influx of houses for sale started to grow. This occurred till there was way more houses on sale than the amount of buyers, and home prices began to fall. This marked the start of the 2008 financial crisis. With thousands of homes being foreclosed and people going homeless, every financial institution that was reaping the benefits of the real estate surge took a huge hit. Investment banks stopped buying mortgages from lenders, and thousands of evicted homeowners flocked to insurance companies that were faced with impossible payouts. Of course, the US government tried its best to keep these institutions afloat, but despite its best efforts, the US was faced with record breaking bankruptcies from huge companies. Everyone in the US took their money out of the stock market, and with 2 million jobs being lost in the process, the global economy stalled. Despite the recession's supposed ending in 2009, the effects of this recession were felt for years after, as it's known to be one of the worst economic disasters since the Great Depression.